Welcome to Wizards Institute, the #1 community to learn smart investing and financial independence.
James Ng has closed over US $1.5 billion in commercial real estate transactions and is an investor in over 6,000 units of multifamily housing in the US. James will share his perspectives on the COVID-19 versus historical economic shocks, his predictions on the market, particularly the real estate equity and debt markets. He will also share his views on the U.S. stimulus package impact for small businesses and real estate investors. Last but not least, James will share wisdom from his favorite investment wizards on how they have successfully navigated muddy waters like today's.
And I really want to drill down today, James, to quality content, really kind of push you a bit on how you see the market and particularly the certain asset classes going, how you see the mortgage going, and how you see this economy kind of like playing out over the next few months and years. Okay, so James, I'll hand it over to you. Thank you for being here. Appreciate it. Yeah, and sorry, we'll do maybe like 30 minutes of Q&A, a little bit chat. The audience, please type in your answers, your questions, and then towards the end, we'll take some of the questions. Okay, thank you, James. Yeah, I'm not. Are you guys hearing him? Okay. I'm not hearing you, James.
There you go. Can you hear me now?
Oh,
Sorry about that.
Yeah, now it's good. Okay.
All right. So can you guys see my screen okay?
Yes.
Okay. So I'm going to take you through a couple slides. These are some slides that I have gone through sort of on previous webinars, and I thought it'd be a good place to start. So are you guys familiar with Howard Marks of Oak Street Capital? He essentially runs, I would call it distressed debt fund, essentially. And he puts out memos once a quarter. And I love this quote. He says, "We may never know where we're going or when the tide will turn, but we had better have a good idea of where we are." And so that's what we're going to talk about today, where we are and how we can forecast where we're going to go and be prepared to where we're going to go. So my background, as San mentioned, sort of born and raised in Houston, went to school at UT, did finance there, was an underwriter for GE Capital for 8 years through 2007 to 2015. And I'll talk about a little bit about that experience as well. And then the last 5 years, I've originated close to $800 million in multifamily debt across 125 properties. And then since 2015, I've invested in about 6,000, 7,000 doors. It's probably been 27, 28 multifamily properties across DFW, Austin, and San Antonio. And then 6 or 7 of those have sold. So I'm about 21 properties right now. So this, I thought we'd start here. I thought this was a good place to, this is sort of your 10-year treasury minus your 3-month treasury, right? And this gives you an idea of when you sort of starting with the yield curve inversion, if everyone can see that. And I thought it was a good place because, you know, it's pretty obvious when you look at it, right? I mean, it's not that complicated here. Is every time you see a yield curve inversion, there's a downturn coming right behind it, right? So the gray is highlighted are the downturns. So you see sort of, you know, early 2000s, 2008, and then this 2019 yield curve inversion. So even without coronavirus, I mean, it was sort of getting baked in a little bit here that this recession was going to come up. And then this is just reflecting the Dow, you know, 2001, 2008, and then where we are sitting today. And then, I mean, we're in Texas, so the price of oil has just, I think, added on to this effect. And, you know, coronavirus is the first, like the first leg, and now oil's down. I don't know what the price is now, $10, $15. So it's just getting hammered this year so far. And so here was the interesting thing that I saw in terms of on the financing side, right? So when we look at the credit cycle, even though I had been in lending for a long time, until I read this, I had never seen it in this way. And so Howard Marks does a good job of explaining this in his memo. He says, all right, so the first 6 steps are really the upside of the credit cycle, right? So you're seeing prosperity, there's a lot of capital in the market, there's no bad news, and essentially more and more institutions are in the business of providing loans, right? And what happens, and we saw this in 17, 18, 19, is that the only way that lenders can compete is by cutting interest rates and lowering their credit standards and providing higher LTV. So what we saw was people were moving away, let's say in the apartment space, from Fannie Mae and Freddie Mac and moving into bridge loans and going higher leverage. So whether that was 75 to 80% to 85% leverage, and those were going to people who didn't necessarily have the track record to substantiate it, right? And so I would say March of 2020, we flipped over to the other side, right? So losses now haven't happened yet for lenders, all right? So that step 1 has not happened, but almost everybody sees it coming, right? So on the CMBS side, in terms of hotels and retail, I mean, the number of people who did not pay their mortgage is going to increase significantly on the CMBS side. And the CMBS market is really the market for non-multifamily. It's really your hotels, your retail, your office, your industrial. Though that CMBS market is going to get hit, and there's going to be a lot of losses in that space. And so, step 1 is lenders see losses. Number 2, risk averseness rises, right? And there's going to be, higher interest rates, more credit restrictions. There's going to be covenant requirements. So you saw Fannie and Freddie in the last 30 days essentially come out and say, look, we want you not only to be 75% levered, but we also want you to put up a 12-month interest reserve or 18-month interest reserve. So you already see we're in that step 2 of credit restrictions, covenant requirements, and then less capital is being made available. So on the apartment side, I'm going to use the apartment side because that's what I'm most familiar with. But like Freddie Mac small balance lenders, they basically, there's 12 small balance lenders, and half of them are saying, look, we're going to add an additional layer of risk right now. And what that means is you might have been underwriting deals. Freddie Mac might do a deal at 75%, but they're only going to do a deal at 70% or 65%. And Freddie Mac might have done a deal in a small market, but now they're not going to do deals in small markets anymore, only major markets. And so people are going to start seeing less capital available, and it's only going to go to your best borrowers. So we're probably right in that number 2, number 3 of the credit cycle. I don't think we've hit number 4 yet, where companies are starved for capital and borrowers are unable to roll over the debt. So right now we haven't seen that. We haven't seen, it hasn't been long enough. We're only 1 month into this thing. I think if it goes to 3-4 months where tenants can't pay and owners don't have the cash reserves, that's going to start leading to foreclosures. But eventually, once the foreclosures work their way through, it's a couple years later, then people start bringing more capital into the market, and people will start giving loans at 8%, 9%, 10%. And eventually that gets whittled down because more and more lenders come into the market. And then it starts back up to the top of the positive cycle, and the economy starts moving again. So I would say sort of like 5 and 6 of the negative side, that was really 2008, 2009, 2010. And then not until maybe like 2012, 2013, did it really start coming back in terms of the credit cycle. So I thought this was super interesting. I had never really seen it this way. Even though I had been in lending, I had never seen it sort of articulated this way. And you can see that this is sort of like a self-fulfilling cycle. It just keeps going over and over again. A couple things. I went back and looked at a couple of the memos that Howard Marks had from 2001, 2008, and they could have been from 2020. Some of the things that he talked about was consumer psychology. I just saw a chart today, basically consumer confidence dropped from, I think it was like over 100 all the way down to 70. And that's essentially in 1 month. And that was you know, that's in the depth of the financial crisis, 2008, 2009, it was in the exact same spot in terms of consumer psychology. Lenders' willingness to lend, I mean, I'm seeing it right now. A lot of lenders are pulling back, and investor confidence, right? So the ability to go out and raise equity right now, all of those have taken a beating. And then this piece of it, right? Success, which has been the last 4 to 5 years, carries within the seeds of failure, and then the failure, the seeds of success, right? So as the next 12 to 24 months come through, there's going to be a lot of failures, but in that, there's going to be seeds of success. You know, Howard Marks talks about the third stage of a bear market. And in that third stage, everyone agrees that things can only go wrong. Okay. And right now, all you hear on the news is negative news, right? Like almost no optimism, nothing is being priced in for optimism right now. And, you know, you can buy assets at prices that reflect little or no optimism. And so I think in the stock market, that was probably like 2 or 3 weeks ago, right? So when prices had dropped, I don't know, the Dow it went from 29,000 to 18,000. So it was down like 30%. I think that's when Howard Marks came in and bought a bunch of stuff. And he said, look, even if if I'm trying to catch a falling knife here, this value he felt comfortable at because there was no optimism really baked in at that price. But real estate's a little different, right? So there hasn't been that falling of a knife yet. People have not got desperate. People have not had to sort of fire sell assets yet. And so we have not seen prices drop. Right now, there's just been a dislocation between buyers and sellers. So this is his, all right, how do you take advantage of opportunities like this? And number one is you figure out what the intrinsic value of an asset is. And then when the price falls below that, you buy it. And then even if the price falls more and more, you average down into that. And then you have to be right about value. And so in 2008, he says, in a few years, we'll reminisce about how easy it was to take advantage of these bargains. And so I did this for DFW, and it looked at the sales price per door and how they got hit in the market. And, you know, starting with sort of your class A, 2008, 2009, those saw a pretty big drop, right? So it went from 134 a door all the way to 82 a door on average. And I see the same thing happening on class A property and lease up right now. So in DFW, we have probably about 25,000 units that are supposed to deliver this year. And then probably another 20,000 that are under construction. And so if you look on the far right, you know, it was class A deals were up to 170 a door. So I think there's going to be, number one, it's going to be tough to lease these properties up. So it's going to take longer to lease them up. And then I see that dropping back down to probably 2014, 2015 pricing. So maybe 140, 150 a door. So there was about a 50 a door drop from 2007 to 2009, and then it comes back pretty strong. But you can look at your class B properties. So sort of this upper middle range, low middle range. They essentially, I mean, they went down a little bit, right? So it went from 82 a door in 2008 to 75, but essentially went flat and then came back very strong. And then it took the lower end. So I would say your C minus D properties, it really stayed flat for, you know, 8, 9, 10, 11, 12, 13. It was, you know, 18 to 20 a door and didn't really move from that. But then in the last 5 years, it accelerated, almost tripled in price. And so I think that's probably where you're going to see most of the hurt is your class A stuff on the top and class sort of C minus D stuff on the bottom. The B stuff I think is going to be pretty safe. You might see a 5 to 10% discount on that, which we're seeing already. But, you know, I don't think it's going to be, you know, a 20, 30% drop like some of these other asset classes. And so on the bottom here, bottom right, I put in a chart of GDP. And you can see that there's 2 consecutive quarters of negative growth, you know, sort of late 2008, 2009, and then we went positive after that. And so one of my rules, and maybe we'll talk about rules later, but one of my rules is I want to see 2 consecutive quarters of positive GDP before I reinvest into a deal right now. And so I think Q1 is going to be negative GDP. Q2 is going to be probably negative GDP. And then Q3 is up in the air right now.
Hey, James, sorry. Yeah, could you, I love this slide. Thank you. Can you just talk a bit more about the drivers of these prices? I'm a bit surprised on the workforce upper and lower, because the last time we saw you, it was obviously just a month of data, right?
Yep.
I think there was a slide that we went through last time that showed the C's, certainly for the month of March, with like as low as 60% collections.
Sure.
But the A's and B's were collecting 90% plus, right?
Yeah.
So this is great testament to workforce at least. But can you talk us through a bit more the drivers of the price declines and I guess in the case of workforce, it didn't change much, certainly in the 2008 era.
So really, it's a function of rents.
Yeah.
And I don't think rents came up. I think rents were essentially flat in 8, 9, and 10 in the workforce, and even the upper to low mid range. I think the rents just ended up being flat for like 3 years, from 2009 probably to 2012. And then 2012, that's when rents just started really ramping up. And what we ended up seeing was a combination of rents increasing, but then also cap rates compressing. And so what we saw was, and I don't have a cap rate chart here, but cap rates on the A stuff, essentially, even in 2012, 2013, were like 5%. Okay. And the B stuff was 7, and C, the workforce stuff was like 9. So in 2012, you could go buy a deal at a 9% cap, right? But then what happened was cap rates compressed across 2000, even from, I would say probably 2013, 14. All of a sudden there was a gap between C to B to A, and the gap was probably only 1%. Like an A deal you could buy at 5%, B deal at 5.5%, and a C deal at 6%. And so that's what caused that price per unit to skyrocket, because rents were going up and cap rates were compressing at the same time. And so, yeah.
Clifton asked a good question. 2010 for workforce lower, that there was a 10,000 number. Is that an aberration, or what happened there?
I don't think there was many trades in.
Yeah, I see.
In 2000, like, I mean, I'm working on a chart for like the sales volume, and I mean, I can pull it up if you got a second. I can just try to pull it up. I had it in my deck here. I haven't put it on a sheet yet, but I had it. Here you go. I was working on my next. So you can see here, I'll make it bigger, but essentially look at the number of transactions in 2006, 2007 for apartments. And in 2009, it basically goes to $1 billion in transactions for all of DFW, right? In 2010, $1.5 billion, $2 billion. I mean, the last 17, 18, 19 have been close to this $9-10 billion level. It's essentially been flat the last 3 years. So down here, there just wasn't much to trade in that space.
I see. Okay. So going back to that slide, it seems to me the collections for the C's are worse than B's, and B's worse than A's. And it seems to me the stimulus package, including the 350 that evaporated in the next stage, are not really channeling down to the lower income folks, right? So again, this chart, except for 2010, it's slightly surprising to me, because it seems to me the lower income folks would be hurt more, and therefore the cap rates would hurt as well. But if I'm reading this, this is a strong testament for workforce. Can you kind of talk more about that, and maybe
so this is historical. Yeah. This is not as of now, right? Mm-hmm. And so I think today's going to be a little different. So let me this is another slide that a broker sent out today. Can you guys see that?
Can you blow it up?
That's as big as I can get it.
Okay, talk us through then.
So essentially, with the CARES Act, they added 600 a week in unemployment. And so you can see on this chart, essentially 55,000. Let me see if I can make it bigger. So at 55, anybody making less than $55,000, they're going to make more on unemployment for the next 3 months than they did with their actual job.
Yep.
And most people's rent, let's say it's 30% of your income, most people's rent in the sort of BC space is going to be anywhere from the 750 all the way to, let's say, 1,400. And they're going to receive anywhere from 3,000 to, they receive anywhere from $4,000 to $5,000. So this is what people are counting on for May, June, and July. So I don't think there was a program like that back here in 2008, 9, 10, 11. I think people got unemployment, but I don't think they got that extra $600 a week. And then I think these cap rates on the lower income side, the C and D properties, those cap rates are going to go back and expand, I think. So that price per door is going to come down more so than the upper mid range, which is more your B product.
Okay.
All right. So I got some lessons from Howard Marks. I like this slide a lot, and we can go into it. But he talks about risk, and I was in risk for 8 years, and nobody ever told me anything about risk the way this chapter did. And so this is from The Most Important Thing by Howard Marks, and he said, investing consists of one thing: dealing with the future. And none of us can know the future. So the best job is to control it. And this chart in the upper right gave me the best idea of risk, right? So as you move out the curve on risk, it's not only that your projected return should increase, that's obvious, right? But your range of return also increases. And so let me give you an example. In multifamily, let's say you buy a deal, you put, a 10-year Fannie Mae loan on it, it's a stabilized property. Your return, let's say, is 10 to 15% IRR in this range, right? And it might go to 20, it might go to 10, but the chance of you losing money on that deal is actually pretty low, right? But then as you move further out the risk curve, let's say you buy a property that's 50% occupied, it needs $10,000 a door in rehab, and you do a bridge loan, and your expected return is 20 to 25% IRR. Yep. So your projected return is right here at 20%, which is higher than my projected 15%, right? But the chance of you going to 40 is higher, but then your chance of going to 0 is also higher. And so the way I think about risk now is, it's not just the projected return, because the projected return is never the actual return that you get. It is a range of returns. And thinking about risk in that way, and risk equaling volatility is how I think about risk now after seeing this chart. So that was a big thing out of his book. And so this is, one of the things that Howard Marks talks about is sort of knowing where we are in the cycle. And the way he describes a bull market, the way he describes a bear market here, the bull market, I think everyone gets, a few people think, things are going well, then most investors jump in. I would say that's 2013, 14, 15. And then, probably 17, 18, 19 was, number 3, the third stage, when everyone concludes things will be better forever, right? Whereas the bear market, there's a few thoughtful investors. I would say that's probably even beginning of 2020, maybe 2019 was when a few people are just like, look, things aren't always going to be rosy. And then I would say in Dallas, the last year, there's been, pretty minor, if any, rent growth, right? So some investors started seeing that, recognizing things are deteriorating. And then to me, we're in this final third phase, right? And, everyone's thinking that there's only bad news right now. So to me, if you look at this chart on the right, you're sort of in between, I would say, fear and panic right now. Because essentially in March, I had 4 or 5 deals. People were best and final. And then once Trump came out and sort of said, look, we're shutting all travel down from Europe, from everywhere. And I think that, that ignited the fear. And then I think people are still sort of in a panic right now. And I have not seen many deals. They've come to market, but I haven't seen deals sort of put together right now. So I think we still got a little bit more time before we go from panic to depression down here. And before we get back up.
Could you show the slide in full view as a request, James? Is it already in full screen?
It's full view on my side. Yeah,
I think it is. Yeah. Okay.
But I can send out some slides after if you want. So that's, I would say, risk cycles. And this is probably going to be hard to see, but this is a guide to market assessment. And, I think looking at the economy, capital markets, what investors are doing, sellers and buyers, and I'm going to probably do this on a quarterly basis, is do a market assessment of where things are. Because I think that's gonna help you pick the right time to be into deals. And so if you look at this chart, everything on the left-hand side, economy is vibrant, plenty of capital, plenty of buyers, strong asset prices, and there's a lot of, general partners essentially hold all the cards. That's when you're in a bull market. And then on the bear markets, pretty much everything's the opposite. And so it's not going to be perfect, but I think this will give you a good idea in terms of, where we stand in the market. Let's see if there's, so I got 2 more slides here, I think. And, people in Texas are familiar with Trammell Crow. People maybe outside of Texas, they've seen their buildings, but Trammell Crow is probably one of the biggest developers here in Texas. And the late 80s, sort of after the tax laws changed, Texas got pummeled during the S&L crisis. And we had more development. So just to give you an idea, in the 80s, so right now in Dallas, Fort Worth, we're building about 20 to 30,000 units per year, okay? In the 80s, they were building 70,000 units a year in the 80s. And we didn't have nearly the population. And so there was a big downturn in sort of late 80s. And the CEO of Trammell Crow basically went out to everybody and said, look, what would you guys tell yourself if we could go back 4 years or 5 years? They're in the good times, they're in the bad times. So these were some of the lessons learned. So during the tough times, number one, cash, right? Cash is king. And failing to hold some of that cash back and instead of making distributions was a mistake that they made. Failing to retain cash, to not be in preparation to have buying opportunities was another mistake. In terms of negotiation, document everything. And because, when deals go bad, memories become very short. On the debt side, they're really focused on working with the best lenders. And in timing, this one's important, is, you don't know how far this thing's going to drop. And so if you come into a deal and let's say I've already seen this today, someone sent a deal out and said, look, are you willing to buy this deal at a 10% discount from what we were going to sell it for a month ago? And some people are ready to jump at that. but you have to have the staying power to make it through, because if this downturn goes 12 months, 24 months, 36 months, you don't have the staying power, you're gonna get eaten up like a fish. All right. So you got to have the staying power. And for acquisitions, they always looked at replacement cost versus purchase price. And then during the good times, they said, look, let's do fewer deals, and let's make sure we manage those deals right. And we should sell more deals in the good times, because like we saw sort of middle March, as soon as the market becomes soft, there's no more buyers. And so sometimes it's better to sell too soon. Their focus is really being in the field. So being close to projects, being near tenants, and their debt. So they were developers. They almost always did recourse debt up front, and then moved to non-recourse. But sometimes they took on more recourse debt instead of moving to non-recourse, when they should have been paying attention to that. And then in terms of team, they said, one superstar, is greater value than unlimited number of mediocre performers. So those were some lessons from Trammell Crow. That's all I had. Those were some slides that from sort of the last, I would say, month or so of webinars that I've done, and just to give you an idea of sort of what I'm thinking. So hopefully that was helpful and gave you sort of some perspective on what I'm seeing.
That's great. Thank you. The slides get better each time. I want to drill down a bit more on some of this, but I want to ask the audience as well. I think I know the answer, but I'm just curious. Maybe you just guys can type it in. What do people see as, are we at the bottom? Maybe just kind of type in what you guys think. Or do you guys agree with what James said? We're really still in the panic stage, and we're still quite a bit far off from that. I'm just curious what folks here are thinking. And then the other questions are, is anybody here actually buying or just kind of looking? Just curious. Anthony, I know Clifton, you guys are active, and in particular in real estate. The folks that are doing real estate here, if you don't mind just kind of sharing your thinking.
Yeah, I could take that real quick. So if we're active, it has to be the right opportunity moving forward. And I have seen some price adjustments from, sellers who brought out property 2 months ago where they were all the way at the top, and they had a buyer for it, and the buyer fell through when in the midst of all this going on. The broker kind of circles back to other buyers, and in some cases it's been pretty significant discounts. But for the most part, to kind of piggyback off of James' presentation, I particularly deal with the kind of the upper end workforce, maybe even B minus. So in terms of fluctuation, there hasn't been that much there, which kind of rings consistent with your presentation. But James, as you presented, we don't really know where we are. I think we're pretty close to the bottom. We're probably a little past the fear, and people are panicking. So I guess we'll see what happens. But it's more of, as an operator, you got to be selective with new projects. And to be honest, if you're an operator, you should be pricing in an event of a recession happening into your model. Just like James said, if the numbers still work and the return's still decent, if there is a recession, you should always have that sensitivity analysis done in the first place to, so you don't get hurt in times like these. So sure. Everything James said basically is true.
Yeah, Anthony.
Okay, can I?
What I'm trying to figure out with general partners right now is, let's say, like there's a deal. Let's just try to use easy numbers. Someone bought a deal. It was like $11 million in 2007 or 2017. They ran into trouble. Now they're undercapitalized. They've been in the deal a couple years. They're only 80% occupied. Then COVID hits. Okay. And you can come in, broker saying, look, you can pick up the deal, assume the debt is $8 million. You can put $1 million down, or $1.5 million. You can buy it for $9.5 million. But you know, it's probably 60% economic occupied right now in terms of people paying. And you're probably not going to get a lot of leases for the next 12 months, new guys coming in the door. And how do you, like, how much of reserve? So if you did a new loan, Fannie and Freddie are going to say you need 12 to 18 months of interest reserve. But what I'm telling general partners is you probably need to raise that money now and put it in your own bank account, because you don't know if this is going to take that long to sort of flush through. And if you come in and you buy it for 10 million bucks or something like that, assume an $8 million loan, and then you end up going down the tubes here and run out of money in, you know, year 2 of this, you know, you might have to sell it for 9 million.
Yeah, and if I could say one thing again, Sam and James, and I would encourage if operators have deals, and this is, you know, this is a small group, so I'm allowed to talk about this. You know, personally, you know, I have a deal under contract, and you got to get creative. If the numbers still make sense in the midst of all this, I would encourage other operators to talk to the seller, see if they'll hold a note back for the reserves, or like James said, you know, an operator could raise it, but I would put the burden on the seller, especially if they're motivated still to sell. Try to get a price discount if you can, and you know, in my example, I actually got the seller. I said, I need to do an agency loan. It's the only liquid option right now. As James mentioned, Bridge was very readily available at very low cost. I said, you know, it's actually better because it's a lower interest rate on the agency. So I said,
Absolutely.
you know, if you still want this deal to move forward, you put up the reserve, and then, you know, we'll draw down on it. Freddie Mac is only requiring 6 months, and Freddie's requiring, yes, 12 to 18.
Yeah.
So it really depends on what lender, what leverage you're at anyway.
Sure.
So,
Yeah.
but
Okay.
it's changing every day.
Oh, yeah.
Yep. I wanted, Clifton, do you mind sharing, Clifton in LA, he's I guess the industrial king, right? Clifton's done a lot of industrial deals. Could you share it sort of from that asset class standpoint, what you're seeing, what your thinking is? You might have to unmute or put on. And while he does that, James, do you guys, I know you guys do plenty of multifamily, but do you do other asset classes like industrial as well? Before
I did while I was at G Capital, but I have not done any industrial here at Old Capital.
Okay.
Yeah, I think the charts I've seen in terms of rent collection, I think industrial was like 99% of their rent was collected, and I mean, I think multifamily was 93, right? So on average so far, sort of month over month, I think, you know, the only deal, Clifton, are you in California?
I'm in California. Yes.
Okay. Yeah. The only deal that went bad on the industrial side for me while I was at GE Capital was essentially like a 3 or 4 tenant, sort of spec industrial, or not spec, I forgot what it's called, but it's sort of like industrial office, sort of flex office space. And as soon as like 2 of the 4 tenants went out of business, that deal was dead in the water. And so I think some of the, I guess, multi-tenanted industrial, if it's smaller businesses, those guys are going to go under.
Clifton? What?
Yeah. Okay. So, you know, we're still in a very heated market in industrial. So, you know, this is a market where the vacancy today is 2%. It's very unlikely that there'll be any new product of substance coming onto the marketplace. There is going to be some pressure from smaller tenants that are having financial problems from the economy. But the decline has been so fast that there's no time for the sellers to react to that economic depression. So if something was on the market 30 days ago, and, you know, 60 days ago, there would have been 20 offers, each kind of elbowing each other aside to buy the industrial real estate. Today, there's maybe 5. so there's less offers, but there's still competition. The challenge is, so sellers have either taken their property off the market, or they're still remembering the prices that they could have gotten 30 days ago. And so the deals are not transacting. So in terms of the general marketplace, I would say first, there's no decline in price, but there's an effective economic decline because there is a slowing down of velocity. So things are not going to be able to close as quickly. Second, there are the institutions that have come back into the marketplace in the last 2 weeks, and they are actively making offers, but typically trying to get a better price than they would have 60 days ago. So that's where the offers are, but they're not getting those prices accepted. So I think it's going to take some time. There's no, like James said, there's no distress in the marketplace. And in fact, not only is there no distress, there's not a lot of people that have to sell.
Yeah. Oh, sorry, please finish.
Go ahead. So, but what's also changing is, before reflecting James' comments about the lenders are changing, the lenders are also less willing to support the marginal buyers. So the buyers that are able to go in and make an all cash offer because they have credit lines or cash on their balance sheets, they may not intend to close that way, but they can certainly make a credible offer that way. Those are the folks that are still going to come to the front of the line. Even a year ago, they were still going to the front of the line, but now those are about the only people that the buyers are going to want to deal with if they have a choice. And so they're going to be making price concessions in order to get there, but it's been too fast a decline for us to actually see it happen in the marketplace.
Hey, Clifton, can you give me an idea of sort of portfolio that you like, size and location?
You mean what our portfolio, or what we look at in terms of product?
Yeah, your current portfolio.
Yeah, our portfolio is about 1.5 million to 2 million square feet. Our typical product is 100 to 300,000 square foot industrial.
Okay. Is that typically like single tenant, or is it multi?
Typically single tenant. We're not afraid of multi-tenant, but we're also not afraid of single tenant. So if we had amazingly, in some of the markets that we're in, it's like LA and Chicago, and even Dallas are markets where you can have a 250, 300,000 square foot building, and it can be too small for a lot of the tenants in the marketplace.
So maybe just as part of the research for this, James, last couple of days, I was just also curiosity, just looking at different asset classes. It seems to me most everyone here believe we're not at bottom yet, and this is going to take some time. Obviously, real estate is lagging. But last few days, talking to brokers and some of the Cushmans of the world on multifamily, exactly as what you guys said. There isn't really any change yet. It hasn't been felt yet. I also call some of the condo brokers and townhome brokers here in Toronto, and we're seeing less activity. Prices haven't changed. What's interesting is, again, out of curiosity, I started looking at some of the hospitality plays, just calling, and we're seeing a bunch of hotels. Quite obvious, right? Because they're empty. That are being offered at good prices. And what surprised me was I was looking at two boutique hotels, one near Gainesville, and actually it's a historic boutique hotel, and one near downtown Tampa. They were short-term B&B, but they're easily convertible into longer term. And the one in Tampa I actually liked. That is a $6 million deal. I was thinking of talking to you, James, about it. But they two offers came in and bought it for cash. So it seems to be there's some bits and pieces already floating out there.
How much was it worth pre-COVID?
So pre-COVID, it was 100% occupied easily on B&B, and essentially it's a beautiful building, 21 units, and they started just converting into long term, and so I think they signed like 3 or 4 tenants long term just in the last 3 or 4 days, and I was like, I want to talk to my lender, because it looks like this is a good convert. It's a great property, great location. He's like, well, no, we have to cash out first. So, but I don't know. It seems to be for most assets, even some of these, it's better to wait and see how things play out, right? It sounds.
Well, I mean, right now, let's take multi, for example. I've only seen one deal come across my desk so far where somebody needs a forbearance, and they're not gonna let go of the asset probably for another 3 to 6 months, right? And most A deals and most B deals, Class A and Class B deals, they have no issue. So unless somebody has a maturity, let's say in the next 6 to 12 months, they're not going to sell right now, right? Yeah. Like why am I going to take a 10 to 15% drop in value just in the last month, even though my collections are the same? Or
well, more than that, unless if they are not involved with a securitized, more a CMBS lender, right? If they're with a bank or a life company, the banks and life companies are going to renegotiate a renewal for them.
Yeah, they're not going to. Yeah, most people don't have. There's 2 reasons to sell right now. One is an impending maturity, or you can't make your debt service, and multifamily owners don't have that trouble right now.
Yeah. Okay. Hey, James, you had a slide from last time that summarizes the different cycles, and we've seen various versions of those types of slides. If you have it, maybe it'd be just we could sort of close a bit in your sharing, and maybe we're discussing a bit more on how you see this time around slightly different or same as before. Do you remember that slide that you showed with Sunrock?
Let me try to.
Yeah, or you can just kind of talk it through, and maybe we'll have a discussion on that. Just this is obviously very different, but obviously there's also a history behind it. Maybe just kind of get a sense of your thinking, what is different, and maybe even some predictions, if you will. I know nobody likes that, but I'd be good to kind of hear it, if you don't mind.
Yeah, let me see if I can see what you're talking about. We're just talking about here, let me try to pull this up.
It was just one slide that had the various cycles, and I think you had some of the real estate implications.
See if I share the screen again. We're talking about this slide?
No, it had the past cycles.
The past
Let me see if I can find it. From the Sunrock talk. Yeah, maybe it was this one.
This one? Okay.
Yeah, I think it was this one. Yeah, just a bit more about this, because I want to keep this a bit more high level in terms of how you see, and maybe Clifton, Anthony, others, how this is different or the same, right? And how history plays into this a bit more.
Yeah, I think duration wise, look at the past, 5 or 6 downturns. They're anywhere from 8 to 18 months, right? We're in month 1 right now. I don't think anyone's projecting a positive GDP in Q2, so that'll be another 3 months. And I don't think many people are seeing a positive Q3. So I think this thing is going a minimum of 8 months. On top of sort of lockdown, on top of oil, those 2 compounding factors, on top of we're going to see who knows how many department stores go under, how many retail stores go under. I think it's probably another year, right, in terms of duration. And I'm going to wait for that first quarter of positive GDP. Okay.
Okay.
Unemployment, I think we've already lost all the jobs we gained from this last economic expansion. This was a chart that I just saw. Let's see. Did I lose it already? I just saw a chart, but essentially in the last 4 weeks, we've lost 22 million jobs. And that's how many we gained from the last recession. So unemployment's already at probably 10%, my guess is, and it's probably going higher. Whereas on all these previous cycles, unemployment maxed out at 11%. And so you've seen the unemployment charts. I mean, this one on the bottom right that was like 2 weeks ago, right? So it was 3.3, 6.6, and then the last two have been in the 6 million range.
Yeah. Okay. So I want to overlay and sort of talk on top of this, because what I haven't seen, I think, actually, in my personal view, I think this is a little too rosy in my view. I think maybe we have a discussion on politics with the U.S. and Chinese situation. I think today Trump sent warships to the South China Sea. My personal belief, and again, don't quote me on this, and this is not an investment advisor or whatever it is this administration in the States would probably do anything to win an election, even if it's calling to war. And it seems to me a lot of the direction, a lot of actions are heading that way. That's one. The second one is, I look for it in the media, but there's very, very scarily little information on what's happening in emerging countries like India or Indonesia with COVID. There's almost no news on it. So I'm curious from you, James, and others, given COVID, even if it's controlled in the developed world, China, but in places like Africa, Indonesia, Brazil, Latin America, and India, where it must be going insane, right? And also overlay that with the politics, especially between US and China. I mean, does anybody have a very negative view, as I also potentially fear? Just curious out there.
So San, before you jump into that, can we make sure that the comments stay focused on how these things affect real estate, which is the purpose of the call?
Yes, thank you. Yes, please.
Okay.
You want to take a stab at it, Clifton? I know you're a macro thinker.
Well, so your question is what's the impact of politics and COVID on the markets that we deal in?
Yeah, I think what James presented obviously is really well thought through. He's a man of action and experience, but also reads a lot. You can tell. What I'm trying to get from the group is, exactly how those two other factors might make this much worse than it is. And obviously nobody really knows, but I'm just curious.
Well, I think it definitely, I mean, the impact on the economy, and I mean, particularly on Main Street, on the retail tenant, I mean, is fatal to a lot of these retail tenants. Are not going to survive, period. They have, they probably have enough liquidity to go for 1 month, and that month is gone. And maybe they haven't got, maybe they'll get some support from the government, maybe they won't, but even if they do get support, it's not going to be enough for the retail guys. Same thing with the hotel guys. It's a little I mean, if COVID-19 were fixed instantaneously at the end of this month, I'm not sure that the hotel guys are, many of the small hotel guys are going to be able to recover. Inherently, the hotel business is, I don't know if we have any hotel guys They've had a good run for 13 years, but it's inherently a bad business. It's a cyclical business. It's a leveraged business. So it's both operationally leveraged and financially leveraged, and your customers walk out the door every day at 9 a.m. And as evidenced by what's happened to them. I mean, I know lots of business hotels that are currently at 3% occupancy, 7% occupancy, and break even is 65%.
Well, when I was at GE, my risk officer didn't allow us to do hotels.
Yeah. Now, the one part that you left out of your assessment of the future, son, is the unbelievable government support that they've kind of opened the spigots, and I think we're seeing financial support to the system that we've never seen before. However, I don't think the government can turn around something that is intrinsically unhealthy, the hits to the economy. What they can do is they can slow down when the hit occurs, and maybe they can slow down the landing, but it's also going to be at the cost of probably stretching out how long the suffering is with us.
So this was an interesting chart. So if you guys read Pensford is an interest rate newsletter that comes out weekly, and he compared 2008 versus today. And in 2008, the issue was securitizations going bad, and that really led to banks failing, and that eventually halted the economy. But here it's the almost exact opposite. It sort of flipped. The economy halted. The tenants stopped getting paid. Tenants didn't pay their mortgage. Borrowers ran into trouble, and now securitizations are in trouble. And what the government has done is essentially put the money at the front of the deal and said, we're going to give you helicopter money. So that's the stimulus payments. That's the PPP. That's all this backing of liquidity. And they're going to get the money in the hands of tenants. Hopefully, those tenants hopefully pay the borrowers, and those borrowers pay the banks. Because the issue is that the liquidity on the financial system is freezing up. And so the Fed and the treasuries, they're essentially buying all the paper out there. And that's I would say the major difference. Nobody knows. I mean, they're putting in money everywhere into the system. So they're putting money into tenants' hands. They're putting money into, that's why 10-year treasury is 0.6 right now. I mean, they've driven it down and are providing liquidity for everybody at this point. And they're going to do it unlimited is what they've said. So.
Yeah.
Can you guys hear me?
Yes. James, maybe you could unscreen it so we could see who's talking. Do you mind, James?
Sure.
We're past 9 o'clock. We'll just do a couple more questions if you don't mind.
Yeah.
Yes.
Good.
Who's that? Yes. Hi.
Hi, how are you? I'm
Great.
Daniel. So I've been listening to everything you guys were talking about, and I'm kind of new to, I guess, this whole realm. So I've been actively trading. And before all this, everything was very sound. I still think the fundamentals.
So Daniel, we can't hear you. There's like this massive.
Dan, your sound's coming in bad.
Yeah.
Hear me?
And there's a lot of static.
No.
Yes, let me try another location.
Yeah, or you could type it. We could read it out if you want to.
Let me type it in.
Okay.
One second.
I have something I can't figure out that relates to what Clifton said. Maybe while we wait for Daniel, I'd love for James and others to comment on it. Is yes, like U.S. is, people joke it's more socialist than China with all this stimulus package. So with this cash printing and QE, is real estate safer than others as an inflation hedge? Does anybody have a view on that? Why or why not? I keep hearing different things.
Why would it not be?
US dollar
Yeah, no, I mean, from an inflation standpoint, I mean, what's funny is you can try to pull up a chart on inflation and it shows 2%, but go look at asset prices over that same period for apartments and deals going from 20 a door to 80 a door, and tell
Yeah.
me it only went up 2%, and tell me rents only went up 2% across the nation. So I think it's a great place to be from an inflation standpoint, especially multifamily that you can reset rents every year.
And you're getting 10% cash on cash, right? So
Yeah.
Clifford, do you disagree or agree?
Yeah, I think the problem is James is too young.
He is young. He is young.
Yeah, I was partner with Gary Schaefer, the guy whose memo you quoted.
Okay.
And in the 1970s, what happened was when rents are going down,
Sure.
then asset prices are going down.
Okay.
And so if the world is in a deflationary mode, which is certainly the case in Germany and Japan and in about 7 other countries, then, and if everyone's moving in that direction, it's very hard for the US to avoid that. Now, I think all the things that the government is doing are inherently inflationary by pumping money into the system. That's inherently inflationary. But I think it's quite possible that you go through a deflationary period of anywhere from 2 to 5 years before you get to that inflationary kind of environment. So I think the challenge for us as active real estate investors is to make sure we get from here to 5 years from now. I think over a 10-year period, James is absolutely right. It's pumping the money into the system has been inflationary. Unfortunately, I've said exactly the same thing since 2010 and have been wrong so far. We haven't seen a lot of inflation in the system. We've seen values of real estate go up, but that's because rents have gone up and that's because cap rates have gone down. But in terms of kind of, I think real inflation has typically been 2.5%. So, oil prices going from 2 years ago at $100 a barrel to minus 27 in Texas yesterday. That's sounds kind of deflationary to me. When we have the S&P at one time, I think energy companies, oil companies were maybe 20 to 30% of the S&P, and now it's 5% of the S&P. That's kind of deflationary to me. So I think it's I kind of go back to the Karl Marx letters. We don't know where the world's going to be, and I'm less confident to being willing to bet that the next 1, 2, even 3 years is going to be a period of ever increasing values. And we need to kind of adjust our business strategies such that we can deal with whatever comes at us.
So the last time we had deflation was the 70s, you said?
70s, yeah.
70s,
And
okay.
well, but real estate's very local. So
Sure.
I mean, there was a period, and I had just come out to California from Texas where we had been clobbered in the 70s, and then all the guys in California were telling me real estate always goes up in value, and don't worry about it. And it didn't happen. Eventually, the recession hit California.
Right. I guess, Sen, what's the alternative?
Yeah, again,
If you
so
know
this
that's-
is
if you know
an allocation question, right? And this is a real estate talk in this tonight, but it's an allocation question. Is Dalio saying cash is trash? But Anthony's deal, Anthony's doing a deal that he's trying to close right now that I think looks a good deal. It's got 8-9% cash on cash. It's stabilized. Exactly. Where is safety and where is yield, right? Because that's my broader question. And then obviously, if we decide real estate is, especially multifamily, is still a place to go with the cash and cashes, tonight you answered a lot of questions on the asset type within multifamily, and that's helpful. So now I'm kind of going higher up in terms of what are the alternatives, right? Again, maybe we could spend a couple of minutes on that.
Let's go back to multifamily because the two asset classes that I generally advocate is basically industrial and multifamily. And the great thing about multifamily is I think in the U.S. market in general and in the California market where I am specifically, there has probably been a lack of housing creation below historical levels and below the rate of family formations for the last 10 to 15 years. So there's this huge built up unfulfilled demand. Now, that doesn't mean that there's a lot of demand for $2.5 million condos in downtown Dallas or even downtown Los Angeles or even downtown New York. There's probably a limit to that. So there's a matter of kind of what kind of demand, but in terms of general housing demand, there's a high need for it, A. And B, given the current financial situation, the likelihood that there's going to be a lot more people able or even willing to buy has probably gone down. So I think your customers for multifamily has increased. Now, the actual rents can come down. I think it unlikely, as long as you are an operator that are willing to meet the market prices, I think it very unlikely that you're going to have substantial vacancies. Because the great thing about multifamily is if you're not renting, you drop your rents by 5%, 10%, you're going to be renting. You give a month of free rent, you're rented. Industrial, in my business, if the demand in there, I can drop my rent by 25%, and if there's no demand, it's not going to generate any demand. So I think multifamily is so what's interesting is, given where you can borrow money today and the low interest rates, as long as you don't over leverage,
okay,
you lock in long-term money, you're going to be able to service the debt.
Yeah. Okay.
So I think there's potentially less stress on the system because of the inherent demand in the marketplace for the product.
Okay.
What's the
what
downside,
I'm hearing,
Clifton? What's the downside of multifamily? Because why are you not the multifamily king?
Oh, well, first it takes a lot. Well, there's a number of things. First there is you got to manage it. Okay.
Third party.
I don't know. And also if you're buying it rather than developing it, I don't know how it works in Texas, but in California, the selling cap rates are not the real operating cash. They leave out vacancy, they leave out
you have to underwrite it,
capital reserves and all that kind of stuff. So that's not, so if you think you're buying something on a 5% cap rate, it's not, the selling cap rate is not the real cap rate. Okay. The other thing is, if there is, if we move to an inflationary environment, and let's call that 5 to 10 years from now, it's likely that cap rates will track that. So we'll have an increase in cap rates. And so if I have a property that's flowing $100,000 a year, if cap rates go up, inherently it's going to be worth less. Now, if I'm a long-term,
what about rents?
Rents will go up.
Yeah.
Rents will go up. That's the nice thing about multifamily is, you can roll over your rents.
every year.
every year. Yeah.
Okay, so that's great. I'm smiling because there's a lot of smart minds here, and so even for a prolonged downturn, it seems to me perhaps if today's underwriting is 8-10% cash on cash, it's still, even if it's a lot worse than that, it still is a nice inflation hedge. I think it's what I'm hearing.
But this isn't a
probably-
time to be stretching. This is a time to just go to core fundamentals and say, you have
Understood.
to buy an asset that will be worth more to somebody, either in terms of buying it as owner or buying it as or renting it as a renter.
Yeah, no, my specific question is from a capital allocation standpoint. If I had $100 and it sits in cash, it's going to be deflated versus if I could potentially find somebody like Anthony and invest passively with Anthony. And if he's forecasting 9% cash on cash, maybe I don't believe him, it goes to 6%. That's still a lot better than cash. Without the liquidity, but still a lot better than cash. I believe that's what I'm hearing. And I think that's what James is saying too, right?
I mean, go ahead, Clifton.
Kind of.
No, I think it's a very.
Yeah. So, son, I'm nervous because most of my conversations with you in the past 30 days, you keep moving over to what the cash on cash return is. And the reality is what's more important is what the return on the assets. The cash on cash is how well you do the financial engineering. So if Anthony figures a way to do 90% debt at 5% or 3%, it's going to have a tremendous impact on his cash on cash return. But while if he only does 50%, it's going to make a difference, but it doesn't change the value of his asset. The value of his asset is affected by what his return on total investment, not his cash on cash number.
So is that like an IRR to you, Clifton?
Or cap rate.
Okay.
Cap rate.
Yeah.
I mean,
again, James can attest to that. I think obviously it's just NOI less than the debt service, right? And obviously the debt has to be correct to get there. But you don't get the cash on cash unless you have the NOI, the strong NOI, I think, right?
No, yeah.
No. The problem is, see, Anthony's a really smart guy. If I give him a 5% return guy, but I give him 2% debt, he'll figure out how to make it very interesting deal for you.
That's right.
Okay.
But you see, I would probably prefer, as a long-term strategy, Anthony can make $100,000 a door work if I give him the right financing. I'd rather be buying quality real estate at $50,000 a door.
No, that's right. So I think you're saying is forget the debt for now and look at the cap rate based on NOI, and that's fine. And I think most of the deals that are still being done are at the north of 5% cap, which is still a lot better than cash.
Right? That's in Texas. It's 4% and under in California.
Okay. All right. Let's. I think James had a comment or potential question. I'm just trying to see, and then not James, Daniel. And James, thank you for staying overtime. This is I'm certainly learning a lot. So Daniel's comment is sound fundamentals. He thinks there's sound fundamentals prior to this. I'm not sure if everybody would agree. If we're floating the consumer for a short time and sending them back to work, I don't see a major drop in consumer buying power. I guess he says it's a question that previously before Corona was still pretty strong fundamentals. Daniel.
So my comment on that is
yes.
Consumer confidence. If you pull up a chart on consumer confidence, the last month it got hammered. I think it went from over 100 down to 70. Let me try to share my screen here. Hold on one second. Here's the screen. Can you guys see that?
Yeah.
So it was over 100, 89, and April was 70. if you go back to, I guess you have to do the 25-year, 2008, 2009, we're almost there. We're almost down to where it was. And it took, so from 2007 up here, we were at 95 or so. It took 9 years to come back. And so I don't think consumers are going to be back. Consumers are 2/3 of the economy. It's going to take them a while to come back. So,
Okay.
I think, was that the question?
I think it was a comment. And again, I tend.
I think it's going to take them a long time before they're coming back and spending the same amount that they were spending before. So that's why I think it's going to take a while for positive GDP to come back.
Yeah, again, I don't want to belabor this, and maybe we should call it a night. So we're running over. My personal feelings, I think this whole political thing. I mean, we're not politicians, but I feel like with this election year and what Trump wants to win, it's going to get much nastier, which is tough to model. And then I'm still really surprised at how little news is in the non-developed worlds in terms of COVID, right? India is not a small country, neither is Indonesia and Brazil. They must be hurting pretty badly, but again, there's almost no consideration. I don't even see Dalio talking much about it. I don't think those factors are really built into even what you said, James, right? I think you gave a great talk, but I don't feel like there's any serious analysis on this yet and building into that for the long term. But we'll see. Hey, listen, I don't want to go. We're over 22 minutes. Thank you, James. Appreciate this. What we'll do is I'll try to summarize the best I can the learnings today into a couple of pages and share with the group. I think there's some requests for your deck. If you could share that, I'll also post that. Jericho will post that into a meetup as well.
Okay.
And thank you, everyone. Thank you, Clifton, Anthony, and Daniel for you guys' input.
All right.
Really enjoyed it. Thanks, James.
Thank you for joining us. Please visit Wizards Institute to access the blog summary of today's session, to learn more about other speakers, and to network with other investment wizards. Wizards Institute, the #1 community to learn smart investing and financial freedom.